So you're an aspiring trader, you're somebody that's trying to get some money out of the market. However, you keep hitting the same roadblocks over and over again, and you kind of don't know what you're doing wrong. You got a million people on YouTube telling you what you need to do. They're talking about their particular strategy is going to be the one that's going to make you some money, and you kind of stuck out there, right? What I'm going to do really quickly is show you some of the things in which I learned that allowed me to stop losing money on trades and put me in a position to be a little bit of a better trader, right? And so that's why you're going to want to watch this video. Now, really quickly, this video is being sponsored by the highestpaid.online option trading academy. So what we're looking for with this particular academy to try to help is people that are working a 9-to-5 and don't like the amount of money that they're making. Person don't like the fact they got to take a lot of time away from their family to make the money that they're making. And also the person that is kind of upset the fact that there's a ceiling above their head from an income standpoint. And regardless of like how hard they work during the year, regardless of inflation, they can't make any more money, right? Now, our ideal person is a person that wants to read, they want to study, they want to learn. They're not looking for somebody just to hand them plays. We don't necessarily have that type of platform. What we really are is a course that empowers people, teaches people how to fundamentally understand the market and go out and apply that fundamental understanding to get the life that they desire. I want to encourage you to look into this before we start to move forward on pricing. And also before we start to move forward about kind of limiting access. There's going to be a lot of changes to what we do in 2023, also 2024. And if you get caught on the outside looking in, it probably meant we weren't the right people for you at the right time. And I understand that, just kind of how life works. You'll have to get on the next go around with the new group of people that show up. So let's go ahead and get into this video real quick, right? And so what we're talking about is how I stopped losing money on trades when I learned this. So really quickly, we're going to go right into it. This is a company named Duolingo, right? They're like an education platform. What's really important is when you're looking at this chart, what you're seeing is that this chart is topping out. So let's go to the 2-year. If we can get it to come up, it's topping out on this range. So at the 2-year, at one time, it was around 200. This is right after they IPO. We see it sold all the way down from there, okay? So it hit this out of IPO, sold all the way down. It will kind of right a little bit above the original IPO price, but we're topping out here on these bars, okay? So we're look like we're on the weekly candles and we're kind of topping out. So let's go back to the 1 year. And so when you see this topping out pattern, a lot of times what you're going to see is what we call a resistance level. And often from that resistance level is where you're going to start seeing a lot of supply come in. Okay, so when you're looking at a market, the number one thing that you want to understand is all markets are based on two principles, supply and demand. Normally when there's more people, right, that want to stock and there's stock available at that current price, it creates more demand. And when there's more people looking to sell the stock than want that stock at that current price, is going to create what we call supply. So therefore, when you're looking at a chart, you're looking for what we call supply and demand zones. And what we're seeing is that at around, I want to say this 140 to 150 level is really a supply zone where there's more people looking to sell at that particular price than the people looking to probably push the price up even higher. That's going to be for a lot of different reasons. Therefore, when I'm looking at this particular chart, what I'm saying is that probably between 140 and 150, unless some news comes out that's different, most likely people are going to be looking to sell this particular stock in those price ranges, right? And if we look at it from March, it gapped up and then moved all the way up into that particular range. So it was trading between 90 and 100. We see a big gap up, right? And then we see it starting to move really aggressively into this particular lane. Now, one thing you got to notice about this particular stock, and we're going to talk about that, it's only like maybe a 23 million float, which is relatively small, right? In my opinion, it's subjective though. Okay, so what I'm seeing is a topping out pattern. To me, we're in a resistance level, we're in a supply zone, and it's very likely that in the near future, people are going to be looking to sell this. And if you really look at some of their documents, you're seeing a lot of insider selling, right? So a lot of the insiders of this company, they're selling these particular shares back to the market at these prices because this is a really good price to get out, because it has not been this price since, let's say, was this 2021? Was the last time I was in these price ranges. This is a really good time to get out of this deal because you're getting out at a high. Now, it may go higher, but you don't want it to go back down to 90. You could have got it at 150, 145 to 150. Now, that's the narrative. Now, there's a lot. This is from just purely a technical standpoint. We're not like any of the things fundamentals. We're above the 50-day moving average. We're very much a dated 200-day moving average. In fact, we're really, really extended off this 200-day moving average. Eventually, the market is going to say this price is too expensive and they're going to refuse to buy it. But you want to ask yourself, at what price do you think that's going to be? Now, here's where a lot of traders get themselves caught up in. Everything technical is telling you that this is going to eventually be a sell-off. All the technical things are telling you, especially on an extended time frame, that there's going to be a sell-off unless some news about this particular company creates such a bullish sentiment. People will continue to buy at higher and higher prices, right? Because what we see, if you look at the yellow line, it's well over its 200-day moving average. So for the past 200 days, people have been deciding to buy this at more and more expensive prices. We believe eventually that's going to run out. But here's the challenge that a lot of people run into. We're talking about right here, illiquid plays, right? This play is very illiquid. First thing, the float is only 23 million. And what you see with a ticker like that is that it could move with very small volume because of how small the float is. Therefore, you don't need a lot of buyers to come in to move it up, and you don't need a lot of sellers to come in to bring it down because there's not a lot of shares available to be traded in the market. This is something that a lot of people miss out on. And it's because they don't really understand supply and demand. When you have a marketplace that doesn't have a lot of buyers or sellers in it, the prices often have the ability to be a lot more volatile because of the lack of buyers and sellers in the market. When you have a much larger market, you have more people involved, there's so many more participating, the prices won't move with that same type of volatility because of the amount of players in a particular market. So one of the biggest things that makes this particular ticker illiquid is the fact that it has a small market. So if we can get the summary to come up, it traded on average 600,000. On Friday, we had a little bit of a sell-off. It traded around 1 million. I think people were exiting their position, but the normal trading range is around 600,000. And most tickers, in my opinion, are very illiquid if they can't even get 1 million on the day, right? So you have a ticker that's not even doing 1 million on the day. It had an outsized day doing little under 1 million, but normally does a little bit over 600,000, maybe almost 700,000. As a stock ticker, to me, that's a very slow moving ticker, right? However, that's what you want to understand. So we're looking at a lot of illiquid plays. What can happen is you can get baited into this because it's so obvious technically that it's probably topped out. So when you go to the options chain, what'll happen is you see more evidence that the fact of the play is illiquid. So one of the things I teach in my courses, I tell people when you're looking at what we call open interest, which is how many people are in that current market at that time for that particular strike, I normally try to look for, especially when I'm talking to beginners, to look for 1,000 or greater. And the reason why you want to look for 1,000 or greater is because you want to have the ability to get out of the play. If you're in a marketplace and nobody else is in the marketplace except you, how do you move with liquidity? There's a lack of liquidity. And I think a lot of people, because in America, we have very liquid markets in America. Therefore, the average American doesn't understand lack of liquidity. If you go to other parts of the world, lack of liquidity is a major issue for them. What we've done in America, especially by leveraging the credit markets, is we've created a lot of liquidity in all marketplace environments, whether it's going to be the stock market, the real estate market, retail. But go to like a really bad area, a lower income area of your city, and you're going to see lack of liquidity in your face. That's an example of what lack of liquidity, where you don't have a lot of money moving around that particular marketplace. A lot of people can quote stuff like the black dollar only stays in the neighborhood 6 minutes, but they don't really, they're just quoting what they heard somebody else say on the television or on the radio. They really don't understand lack of liquidity, because if you see it in person, you should be able to understand it. You should not be able to just understand a talking point. So you can go to certain areas of your city and you'll see lack of liquidity. But for the most part, the United States doesn't have real liquidity issues, right? What you're looking at on this particular options chain is a lack of liquidity on the chain. There's not a lot of people on this particular chain. So it means what? There's not a lot of money moving in and out of this chain. And when you enter into a marketplace, if there's not a lot of liquidity, one, it can be difficult to get into the market. Two, you can get into the market and can't be able to exit out when you want to. Why? Because where is liquidity going to come from? What you saw with Silicon Valley Bank, as their depositors started pulling their money out, what were they going to have? Liquidity issues. Because we can't pay anybody else, because we know that fractional reserve spending, things of that nature, banks don't hold their deposits, they loan them out. If everybody starts calling the deposits back, we've loaned out the deposits, we can't make everybody whole, so now we're going to run into an issue. And often what they do is they go to other banks to make themselves liquid so they can get over that particular crisis. But with this one, there was so many people at one time, deposits got withdrawn so fast they ran into liquidity issues. It happened to Robinhood, I want to say 2 years ago. They were worried about liquidity with the GameStop play. So what they did was they cut down all trading. Liquidity is a really, really big deal in any market. I would encourage people to want to be in markets that are liquid unless they can withstand the lack of liquidity in the market until the market becomes liquid. But the challenge is that if you're in an illiquid market and you want to exit, you may not be able to exit. Why? Who's going to make you whole if there's no money already in the market? Therefore, when you're looking at an options chain, what you want to look for is liquidity, right? So I always told anybody that learned from me to look for 1,000 or greater on open interest, especially as a beginner. Once you get more experience, you can make different type of moves because you have experience. But if you're looking at the open interest, the only one that's 1,000 for the 19th of May, which is the end of this particular, I'm sorry, is next week, next Friday, is a $200 call strike at 1,800. And then we have this 2,900, which people just started filing into this position, I want to say on the 10th of this month at the 130 put, right? So that's 2,900. There's no liquidity really on anywhere else on this particular play. So what's one of the challenges of a lack of liquidity? Let me zoom this up a little bit. So look at the bid, the ask, and the last price, even though this has 2,900. So what you're seeing is what we call a widening of the spread. And so anytime you're looking at a securities market, but you can let's relate this to real estate, because I think more people can get it. If I'm trying to sell a house at let's say I'm trying to sell a house for 100,000 and the buyer only wants to pay 80,000, our prices are really, really far apart. So the spreads are really, really far apart. What we would want is that I'm trying to sell the house at 100,000 and the buyers are looking to probably buy at 95,000. Now it creates a lot more of a favorable marketplace, because why? The people asking and the people bidding are a lot closer together. A lot of times when you're looking at a particular options chain and there's a lack of liquidity, another characteristic of that particular chain is you're going to see the spreads really, really wide. Now, because of lack of liquidity, that can often cause the spreads to be wide. Now, here's the problem. Here's the danger of this particular type of play. Let's say I am trying to sell a house, right? And the house is selling for 100,000, but there's only 2 people that want to buy the house in the market. There's a lack of liquidity in this marketplace for this particular house. So we have not been able to establish a market for this house, right? That's the real estate agent's job. They're both bidding 70,000. Well, the problem is that I can't exit out of the play at the price that I want because they're only bidding 70,000. So I say, well, you know what? Let me sit on the house with the hope that over time the market gets better and it gets closer to my price. But there's no guarantee that's going to happen. So 90 days later, I go back into the market. I say, hey, I want to sell this house for 100,000, and the bids come in at 50,000. So what I should have did was took the 70, because now they're bidding at 50, because we still have the lack of liquidity. There's still only 2 people bidding on this property, right? So the problem is that there's really not a market for this property at that particular price that I want to bid it at, I want to ask for. So what I have to do is bring my ask down to meet the bids. So what am I doing? I'm taking a haircut on the property. It's the same thing on the options chain. When you're looking at spreads really wide between the bid and the ask, right? You also could look at the last price. The reason why it can be dangerous to enter into these particular markets is because if on this particular play, the ask is 160, I'm sorry, the ask is 165, right? And the bid is 30 cents. Well, that's a big difference between 165, which is 165, and 30. There's a lot of room there. Now, you got to hope, right? If you're looking to buy, you want to ask yourself, how much lower would they go than 165? But then here's the problem. Let's say you get in at 160. Let's say you even get in at 100. If the bids are still 30, then how do you get out of the play? So if the market still doesn't become tight enough and liquid enough, you could get in at 100 and say, hey, I got a great deal on this particular contract, because they were asking for 165. I was able to get in at 100. Okay, now how do you get out if they're still bidding 30? Right? And this is how you can get trapped in the play. Now that's if everything goes the way you want it to go. Let's say things don't go the way you want it to go, and the bids go from 30 now to 25 or maybe even 20, right? So now, even though you got in at a discount, you got to now take a big loss on your position just to exit out of the market, because there's a lack of liquidity in the market. The bids are very, very broad. And now you got to take whatever price they're willing to give you just to exit out of your play. So normally when you're in a very liquid market, you can be on the wrong side of the play, but you don't have to take as much as a haircut to get out. If you're in a very illiquid market and you want to just get out right now, the lack of liquidity means you may even have to take more of a haircut or take more of a discount to your position just to get out of the market. Therefore, with this particular play, even though I can tell that the price most likely is going to move down, the question is, the lack of liquidity in the market means that it's probably not a good play to be in. And I will look to find easier situations for me to make money instead of going into this situation, which could be very difficult to exit. I could get in, but it may be difficult to get out. And that's if everything goes my way. So if you look at, that's the May 19th. This is the June 16th, right? You got 979 on the 120, but look at the spread. So the last price paid was $2. They're asking for 250, but they're bidding 90. That contract lost 14% on the day. That's weird because it's a monthly contract, right? So that's the highest one. You got the 15. Wait, the ask is $75. They're bidding $5. Last paid was 75. Okay. You got the 1500. The ask is $30. There's no bids on it. And the last price was $5. Right. On the top side, you have this 1300 at 210, which is not going to happen. Ask is 10. There's no bids. And the last price paid was 5. Okay. Let's go to the July 21st. You have nothing in the thousands. On the other side, on the put side, you have nothing in the thousands. You got 136. Those bids aren't bad, but they're also not great. These bids are not bad, but they're also not great. 1110 and 1050. But you got 6 open interests. But these aren't bad, right? Let's go to the August 18th. You don't really have anything there. This is not bad. This is 388, 1160, and 1110. That's not bad. But the last one was 1080. Right? 580, 210, big difference. Even though this is 961, this would be 1,000 after the weekend. 580, not okay. It'll be close to 1,000. Let me correct myself, after the weekend. But you got 580 and 210. So they're asking for 580, they're bidding 210. And you have the same thing on the downside. These are tight. This is not bad at all. It's 1250 and 1210, even though you only got 69 open interest, right? That's August 18th. Somebody alerted me on this contract here, the 95s, but look at the bid and the ask. The ask is $8 and the bid is $410. So where do I come in at? But somebody alerted me about this particular strike. I want to say maybe 3 days ago. Somebody I know on Twitter, right? So now here's another characteristic of liquidity on an options chain. If you look at these particular chains, you're only getting monthlies. You got May 19th, you got June 16th, you got July 21st, you got August 18th, you got November 17th. Normally, when you're looking at illiquid options chains, they're only going to give you monthly contracts. You're not going to get weekly contracts. More liquid chains give you contracts all the way from every week, and then you also get monthlies. When you're looking at more illiquid chains, you're only going to get monthlies. And that's normally characteristic of a very illiquid market. And these are the things in which it doesn't matter what strategy you use. If you go into illiquid markets, regardless of the market, it can be very difficult to negotiate what you want because there's not enough demand in that market to equate the liquidity, to equate the amount of people in the market to where you can move around like you want to. Now, if you and the buyer or you and the seller can agree one-to-one, that's not a bad thing. But once you're off on price, there's really nowhere else for you to go because there's not other participants in the market that can come with an alternative to what you got going on. Okay, that's something that I encourage people to really watch out for. And you can apply this to any market. So this is really like in the relationship space. A person is looking for this type of person, but that type of person is like less than 5% of the country, right? So the problem is that you're looking to participate in an illiquid market. But there's no money in telling people that. The money is in telling the person that everything's wrong with the world, that you can't get that kind of person. But if you're going after less than 5% of the population, well, that market is illiquid because there's not a lot of people. So then the question is, how do you participate in a market that's illiquid? And then the question is, once you enter into that market, do you have what the 5% want? Are you and that particular person, are y'all far apart on what they're asking for and what you're bidding with, and then what you're asking for and what they're bidding? And then also you're in an illiquid market. So this applies to any marketplace that you go into. The next one we want to talk about is your position size is too large. It doesn't matter what strategy you take, right? Anybody telling you they got a guaranteed strategy, they got a guaranteed way, they got a 99% return or win rate. None of that is important if you are positioned too wide. And so what I mean is that you could be playing a 99% strategy to where every 9 out of 10 times you're going to be successful. However, if you're not using good risk management, if you're not managing your account size properly, you could win 9 times and lose everything on the 10th play. So nobody has a 100% strategy. So if we say we got a strategy where you're going to win 9 out of 10 times, 9 times in a row you win, but you're having bad risk management, you're not managing your account properly. On the 10th time, you lose everything because it was a 9 times that you were not managing your account properly that made you continue to reinforce your bad management habits. So this is why with a lot of people, them making money is the worst thing that happened to them. Why? Because it reinforced their bad habits. I knew a guy that told me a story about he taught a person how to make money in the markets. The guy was making like $10,000 a month. That was a lot of money to him. He started taking drugs and doing this and the third because money was coming easy. Well, he was already doing that before he started making money. Him making money now just reinforced his bad behavior. So he went broke anyway, even with the skill of having to make money on the markets, because his behavior patterns before he ever came into the market was already bad. Then he just got more money, so it just fueled his negative behavior. If you're bad at capital management, if you're bad at risk management outside of the market, the strategy is not important because you're gonna continue to engage in that kind of behavior in the market. Therefore, it doesn't matter how much money you make, you're going to give it all right back to the market. And we see this with people in every area of life. And so what destroys a lot of people is they have bad risk management. They don't understand position size, right? They have success, and then they think, well, I can do what I've always been doing in this particular space, right? Even though you didn't get away with it in other spaces, but you're going to try that here, and you're not going to get away with it here either. People do the same thing in the real estate market. They want to get big fast. So they take a lot of bad situations, real estate, take on a lot of bad debt. They over leverage themselves. What happens? They end up losing everything. Well, that's how they run their life anyway. It's either boom or bust with some people. There is no happy median. A lot of times in the markets, a slow, methodical pace will get you rich faster because you get to keep it than trying to get there overnight. But a lot of people believe in the overnight success story. Therefore, what they do is they trade really, really aggressively, and they look for the guaranteed way to make money. There is no guaranteed way to make money. But they buy into that because they want to get rich fast with a guaranteed way. Then what they do is they pile on large positions. Well, nobody has a 100% accuracy rate on anything that they're telling you. So it can work 99 times. But if you keep doing it, it's the one time it don't work or does not work is what's going to destroy your account. Then what you do, you start all over again. And that's the loop that some people play until they just leave the market. They do the same thing in real estate. They do the same thing in business. I've seen people build businesses up, make a lot of money. They destroy the business. They start all over again. And they just do that till they can't do that anymore, right? This is their behavior pattern that they're just involved in. It has nothing to do with options trading the market. This is a behavior pattern that they're in. Many times they were socialized. They were taught this in their household to engage in this kind of behavior. So they was raised that this is just how people conduct themselves, right? So that's one of the things that I learned about is position size. Often in this market, if you can just be very methodical and take the small wins, even when you see a big win right in front of you, sometimes if you just take the small win, it's over time is where you're going to win. Trading is really not that difficult. What's difficult with people is behavior management. It's not the trading. Trading really is very easy. It's easier to trade than it is to drive down the highway, right? Because you can't lose your life trading. You can lose your life on the highway. but it's the behavior management is what gets everybody, myself included. You got to constantly be observing and managing your behavior. Am I too exposed? Am I taking on too large of a position? Am I being greedy here? Because often we're comparing ourselves to what other people are doing, and you don't know their whole situation, but you're comparing yourself to it, and you're saying, well, if they're doing at this level, I should be doing something comparable. But you got to trade your own account. You don't know what they got set up, why they're able to do what they can do, right? And so that's what destroys a lot of people. And position size too large is going to be relative to your account. For one person's account, it may be they can put $10,000 on a position. Other person, it might be they're going to put $100. But you got to trade your own individual account as opposed to looking at somebody else's situation and thinking you're going to replicate yours with what you're doing. It doesn't necessarily work that way. And that's what destroys a lot of accounts. Trading, I'm telling you, is easy. Some people learning the market is difficult because they don't want to read and they don't want to study. And they just really like business and money's not their thing. But placing a trade is easy. It's like going to the store and buying something. It's the management of the trade and it's the behavior management is where most people struggle. And they blame the market, but they don't look at their own behaviors. The reason why Vegas gets so much money, Vegas knows people's behavior patterns. So all Vegas does is just play off your behavior pattern. Really gambling is easy, but once Vegas realizes that you have the edge, they just ban you from the casino. So it's not that Vegas can't be beat. It's once Vegas realizes that you have the psychological edge, they just tell you can't come in their casino anymore, right? Now, the market won't do that to you, but most people never gain a psychological edge in what they're doing market-wise to actually do any real damage in the market long-term, right? And that's the real final frontier. So didn't want to be long. This video is not about me saying the same thing over and over again, but I'm I have a lot of confidence that if you apply this to what you're doing, not just trading, but to all your marketplace behavior, and then if you examine your behavior, well, I'm doing this in the market, where am I doing this in my life? Because what you're doing in the market, you're doing in your real life. So then ask yourself, why are you doing this in your real life and then bring it into the market? But you have to be observant of your behavior and not just caught maybe in a trance that you've probably been doing for the past 10, 15, 20 years. So I hope you got some value from it. David W. Williams, also known as Diamond Dave. I'll talk to you later.